Hello, lovely people out there. I'm Kate Hill, and welcome to our weekly Adviseable property news update. Now, you know that I'm giving you the best commentary and content here on our channel. So before we do anything else, as always, please let me ask you to just quickly hit the little subscribe button down there and the notification bell so that you're getting all our expert hints and tips around buying, owning, and investing in property as soon as I post them. And if you're finding this free content useful, then please click on the all-important like button too. It just means that YouTube will recommend this little video to the great people out there. I really appreciate that support. Now, I'm sitting here talking to you today as a property professional. I've been in the real estate industry for a really long time, advising and helping people. I've seen most things happen. I've gone through the cycles, the ups and the downs, and most importantly, I own and invest in property myself. And I am out there every day at what I like to call that property coalface. And I genuinely care about empowering you, all of you, to get the best outcomes for yourselves when it comes to property. So please stay tuned. Join me for the next few minutes and I will cover off on consumer confidence reaching its highest levels since 2010. A summary of recent house price growth. November quarter data reveals the contributors to the post-pandemic property recovery. And October seeing a big monthly drop in home loan deferrals. Now, if you are facing the dilemma of whether to buy a home to live in or an investment property first, then watch my video here. I've also listed it in the description below there, which I hope that will give you some help with that really quite difficult decision-making process. Okay, consumer confidence has continued to surge, reaching its highest levels since October 2010. The Westpac Melbourne Institute Index of Consumer Sentiment lifted by 4.1% to 112 in December, up from 107 in November. Westpac's chief economist, Bill Evans, has said that renewed optimism around the job market had been a strong driver of that surge. He said that contributing to this improvement is likely to have been the government's winding back its forecast for a 10% unemployment rate by December, and the widely reported October employment release, which printed a remarkable 178,000 new jobs. Many other news outlets are also reporting that job advertisement figures are back to what they were pre-pandemic. Westpac goes on to say that consumers may also be detecting a shift in labour markets through their own direct experiences. Westpac is saying that the recovery from this recession has been quite different from the global financial crisis and the 1990s recession. So while the index reached comparable lows in all three of those episodes, the recovery in sentiment in this COVID-led recession has been much more rapid. So what's interesting is that after 8 months following the low of the GFC, sentiment had only recovered by 8.4%. And it took a full year before it was clearly signalling that that crisis had passed. In the early 90s, it took nearly 3 years from the lows before consumer sentiment was into a sustained upswing. The surge in confidence provides some hope that the scarring effects typically seen after recessions won't be as prolonged this time around. The reasons behind this particular recession are, of course, also quite different. Also demonstrating a sharp recovery was the weekly ANZ Roy Morgan Consumer Confidence, which was released a few days ago, and here it was higher than a year ago for the first time in 18 months. But overall, consumers are still worried about their finances. Although the surges in consumer confidence are encouraging, some surveys do show that consumers may not be as keen to start spending in the new year as the government might like them to. They found that 55% of people were trying to save more, with only 13% expecting to increase their spending on last year's level. 71% said that they would use any savings from interest rate cuts to pay off their home loans faster. Isn't that awesome? Of those who didn't plan to put it towards their home loan, 95% said that they would save the savings. More than 60% of JobKeeper and Job Seeker recipients said that they would be worse off when the programs were rolled back and eventually ended. It suggests that people weren't ready to raid the coffers that they had worked hard to build through the pandemic. Terry Ryder and CoreLogic have summarised the last few months of real estate activity for us really quite nicely. The price data from 4 major research sources shows how well residential property has done during the year of the pandemic. Earlier in December, the Australian Bureau of Statistics published its data for the September quarter, showing that all capital cities except Melbourne produced growth in residential property prices during that quarter, and that all cities except Darwin delivered annual growth. Domain published its September quarter figures, showing that all capital cities, except Melbourne, had house price growth in that quarter, and all cities had annual growth. The national result was a 4.6% rise for the past 12 months. SQM Research's weekly price index shows that nationally house prices have risen 8.5% and unit prices 7.3% in the past year. 7 of the 8 capital cities recorded annual growth in house prices. The SQM figures show that regional Australia is generally doing a lot better than the capital cities, and we've reported on this in previous news updates. This table of figures here shows month-by-month results from CoreLogic. Since February, when the pandemic struck the nation, I guess for real, there have been 9 completed months of house price figures, and Canberra and regional Tasmania have recorded house price growth in all 9 of those months. Adelaide, regional Queensland and regional New South Wales have recorded increases in 8 of those 9 months. Brisbane, Darwin and regional South Australia have had growth in 7 of those 9 months. And in annual terms, 13 of these 15 market jurisdictions, 8 capital cities, 7 regional areas, have recorded house price growth in the past 12 months. The best performers of all of those have been regional Tasmania, which is up 10.6%, Darwin up 9.1%, Canberra 7.8%, and regional New South Wales up 7.4%. All jurisdictions except Melbourne had rises in the September, October, November quarter, including quarterly rises of more than 3% in Adelaide, Canberra, Darwin, Hobart, regional New South Wales, and regional Queensland. CoreLogic's quarterly economic and property review highlights the November quarter data that reveals contributors to post-pandemic property recovery. Nationally, housing market values did not see the large declines anticipated at the start of the COVID-19 pandemic, when it was all doom and gloom, property declines 30% forecast. Housing values fell just 1.9% between March and September before moving into a recovery trend, increasing 0.4% nationally through October and 0.8% in November. CoreLogic's head of research Australia says that relative to previous housing market downturns, the current decline through to November seems relatively mild, with dwelling values just 0.7% below pre-COVID levels. There are numerous factors which have contributed to the prevention of a larger downturn in dwelling values, including the institutional coordinated response to the pandemic, which have seen low borrowing costs, added incentives for first home buyers, and the extension of mortgage repayment deferrals, limiting forced sales. Despite an initial slump in housing finance through the beginning of the year due to the COVID-19 pandemic, the year to October saw a remarkable 14.5% lift in the value of finance secured for the purchase of property, according to the ABS lending indicators. CoreLogic says that the post-COVID mortgage lending boost was driven really by owner-occupiers, including changeover buyers such as upsizers and downsizers, as well as buyers getting into the property market for the first time. Money lent to first home buyers saw the fastest growth rate at 35.1% in the year to October, accounting for 22.1% of lending, which is up 18.8% in the year prior. Meanwhile, investor mortgage lending increased less than 1% in the same period. There are several factors that contributed to this growth in first homebuyer activity, including generational trends, monetary and fiscal incentives, and lower dwelling values and competition. So let's consider the home loan freezes and this impending deferral cliff we keep hearing about. As I've spoken about previously, the expiry of deferral arrangements for mortgage holders who were affected by COVID-19 does still present a level of risk for some housing markets. But October saw the biggest monthly drop in the portion of home loans deferred at a time when house prices rose nationally. From September to October, deferrals fell from 7% to 4% of all housing loans. Add to that the institutions that are choosing to extend concessions further. They are offering their clients extensions to those deferrals. In July, APRA extended the temporary capital treatment for deferred bank loans to March 2021. CBA have reportedly placed a moratorium on foreclosing against customers unable to return to normal payments due to COVID-19 until September 2021. The risk posed by the end of repayment deferrals may be mitigated by its coinciding with property price rises. With only 10% of housing loan deferrals exposed to a loan to value of greater than 90%, rising home values actually reduce the risk of negative equity where the borrower is forced to sell. While there are still markets where these deferrals might be concentrated, see my Sydney and Melbourne videos, housing finance conditions across Australia do seem pretty stable. The risk of high stock levels putting deferred borrowers into negative equity seems to have reduced. Please don't forget to subscribe to our channel. Leave me a comment below. Tell me the kind of content that you're interested in and what you're finding useful. And don't forget to just hit that like button too. I really appreciate your support, and I will see you again really soon. Bye.